Hey everyone, welcome back to Corporate Decoder, the place where we take companies and put them on the analyst couch because these SEC filings, they tell a story, a very long, very detailed story. And today we are looking at Matador Resources Companies Form 10. Q filing for the quarter ended the 30th of September 2025, and let me tell you, it is packed with numbers, so buckle up and let's decode this thing together. Before we dive in, if you love breaking down complex financial documents into plain English, hit that subscribe button and ring the bell so you never miss an episode. Also, make sure to join our Discord community linked in the description below. We have great discussions over there about these filings. Alright, so this is a quarterly report from Matador Resources Company. They are in the oil and natural gas business, primarily focused on the Delaware Basin in New Mexico and Texas. But they also have some operations in Louisiana. Let's jump straight into the numbers to see how they are doing. First off, the condensed consolidated balance sheets give us a snapshot of the company's finances as of the 30th of September 2025 compared to the end of 2024. Looking at total assets, we see an increase from about $10.85 billion at the end of last year to nearly $11.65 billion by the end of September 2025. This growth is partly due to a significant rise in property and equipment, especially oil and natural gas properties. On the other side, liabilities also grew with borrowings under the San Mateo credit facility, jumping from $615 million to over $815 million. This suggests they are taking on more debt likely to fund their operations and expansion. Now for the good stuff, shareholders' equity shows a healthy increase. Total shareholders' equity rose from about $5.46 billion to over $5.85 billion. A big chunk of that comes from retained earnings, which grew substantially, indicating the company is profitable and keeping its profits rather than distributing all of it. Moving on to the income statements, we can see how the company performed financially over the last quarter and the first 9 months of the year. Total revenues for the third quarter increased to about $939 million this year, from around $900 million last year. That is a positive sign, but when we look at the first 9 months, revenues jumped from about $2.53 billion to over $2.84 billion, which is a significant increase. The bulk of this revenue comes from oil and natural gas sales, which went up nicely in both periods. But expenses are also climbing quite a bit. Depletion, depreciation, and amortization, that is essentially the cost of using up their oil and gas assets and their equipment, went up significantly from about $243 million in the third quarter last year to $305 million this year. For the 9-month period, it jumped from almost $681 million to over $889 million. This increase is directly tied to their higher production levels. Despite higher revenues, net income attributable to Matador shareholders actually went down in the third quarter from about $248 million last year to $176 million this year. For the 9 months, it decreased from around $671 million to $566 million. This indicates that while they are selling more, the costs of doing business are growing faster. This drop in net income is reflected in earnings per S-share, which fell from $1.99 last year to $1.42 this year for the third quarter. The statements of changes in shareholders' equity show how the equity accounts changed over time. Looking at the balance at the 30th of September 2025, we see that common stock, additional paid in capital, and retained earnings all increased compared to the end of 2024. This is good news, showing growth in the company's equity base. Interestingly, treasury stock also saw a big jump from a very small amount to over $57 million. This means they bought back a lot of their own stock, which can be a way to increase shareholder value. They also declared dividends, meaning they paid out money to their shareholders, which is always a good sign for investors. Now let's look at the cash flow statements to see where the money is actually coming from and going. Net cash provided by operating activities increased to $1.95 billion this year, from $1.67 billion last year. This is a strong positive, showing that their core business is throwing off more cash. However, their investing activities show a massive outflow of cash. Drilling, completing, and equipping capital expenditures alone were over $1 billion this year, compared to $905 million last year. They also acquired Amid of last year for a huge sum of around $1.83 billion. Financing activities show a complex picture. They repaid a lot of money under their credit agreement, but also borrowed a lot. The overall picture for financing activities shifted from a net cash provided of $1.57 billion last year to a net cash used of about $379 million this year. This suggests they are managing their debt and investments quite heavily. When we look at the 9 months ended the 30th of September 2025, net cash provided by operating activities was $1.95 billion, and net cash used in investing activities was $1.57 billion. This shows they are investing heavily in their future operations and likely in growth. Financing activities used about $379 million this year, compared to providing $1.57 billion last year. This difference is largely due to significant debt and equity issuances last year for acquisitions. For the 9 months ended the 30th of September 2024, net cash provided by operating activities was $1.67 billion. This past year saw a massive outflow related to the acquisition of Amid, of which cost them over $1.8 billion. The large inflow in financing activities in 2024 was mainly due to issuing senior notes and equity to fund these huge purchases. Now, the notes to the financial statements provide crucial details. They use the full cost method for their oil and natural gas properties, meaning they pool all their exploration and development costs. When we look at revenues from contracts with customers, they've seen a solid increase across the board. Oil revenues, natural gas revenues, and midstream services revenues are all up. Oil revenues for the 9 months are up to $2.18 billion from $2 billion last year, but the price they got per barrel dropped from $78 to $67. This means they produced a lot more oil to make up for the lower price. Natural gas revenues saw a bigger percentage jump from $247 million to $353 million for the 9-month period, and crucially, the price per megacoulomb F went up from $2.25 to $2.49. This combination boosted their natural gas segment nicely. Interestingly, they had an unrealized loss on derivatives for the 9 months of 2025 to $12.3 million, compared to a gain of $25.4 million last year. Derivatives are basically financial bets they make to protect themselves from price swings. The section on derivative financial instruments tells us they use these to manage their exposure to oil and natural gas price volatility. They have open contracts for oil costless collars, which means they set a price they will buy at and a price they will sell at to limit their risk. They also have natural gas basis differential swap contracts to manage price volatility in different natural gas markets. Fair value measurements tell us how much their financial assets and liabilities are worth on the open market. Most of their derivatives fall into level 2, which means their value is based on observable market data. Here we see their commitments. Matador has significant future payment obligations for things like transportation and processing agreements. These commitments total over $697 million for services, with third parties, and another $758 million with San Mateo, their own midstream joint venture. The segment information shows how their business is divided. They have 2 main segments: exploration and production, and midstream. The exploration and production segment is clearly the larger one, with over $9.6 billion in assets, and generates most of the revenue. The midstream segment, with around $1.8 billion in assets, handles their pipeline and processing operations. Looking at operating income for the 3 months ended the 30th of September 2025, exploration and production brought in $265 million, while midstream added about $72 million. This confirms oil and gas production is their main moneymaker. The management discussion section explains their performance. They had a 19% year-over-year increase in oil production and a 26% increase in natural gas production in the 3rd quarter. This is a big jump, yet their net income attributable to shareholders decreased significantly for the 3rd quarter of 2025 compared to 2024, from about $248 million to $176 million. Their adjusted EBITDA, which is a way to measure overall performance before certain costs like interest and depreciation, actually increased slightly for the 9-month period to $1.8 billion. This suggests their core operations are strong, even if GAAP net income is down. They've increased their capital expenditure budget for 2025 to a range of $1.47 to $1.55 billion. They are clearly investing heavily in the future, especially in the Delaware Basin. They also increased their quarterly dividend to $0.375 per share and authorized a share repurchase program of up to $400 million. These are shareholder-friendly moves. Looking at the 9 months ended the 30th of September 2025, net cash provided by operating activities was $1.95 billion, but they used $1.57 billion in investing activities. This is very active management of their assets. And financing activities used $379 million this year. Overall, they are putting a lot of money back into the business. The adjusted EBITDA reconciliation shows that even with higher expenses, their core business is churning out cash very effectively. Alright, let's wrap this up. So what is my take on Matador Resources Company based on this filing? Matador Resources is in a strong growth phase. They are producing more oil and gas than ever before, and their midstream operations are also picking up. This is ref. Lel. Sectored in their rising revenues and strong cash flow from operations, their decision to increase capital expenditures and dividends while also starting a share buyback program shows confidence in their future. They are definitely big on the Delaware Basin. However, there are some headwinds. Their costs are increasing significantly, especially depreciation, exploration, and operating expense. as this is eating into their net income even though they're producing more and getting better prices for natural gas, the lower oil prices. Compared to last year are a definite concern for them. They are also carrying more debt, particularly with the San Mateo credit facility. My overall assessment is that Matador is a well-run company that is aggressively pursuing growth. They are leveraging their assets and making smart investments. The good news is their core operations are generating plenty of cash, allowing them to fund expansion, return capital to shareholders. And manage debt, the risk is that if oil prices take a significant downturn or their operating costs continue to outpace revenue growth, it could put pressure on their profitability and their ability to fund all these initiatives. So key for Matador looking ahead will be managing their costs effectively while continuing to expand production and capitalize on favorable natural gas prices and any potential increases in oil prices. So that is our deep dive into Matador Resources Company's latest SEC filing. What do you think about their growth strategy and their financial performance? Let me know your thoughts in the comments below if you found this break down helpful. Please give it a thumbs up and subscribe for more corporate insights. And hey, don't forget to join our Discord community linked in the description for more great conversations. Thanks for watching Corporate Decoder, and I'll see you in the next one.